All right, Tess. Well, thank you for that introduction. I greatly appreciate it. Funny story about reno loans. The first one I ever did, I actually did get sued, and it was a huge issue with the contractor not getting the draw schedule figured out properly, and it went completely bad. Luckily, that was in 2011 when I was starting out, and we've learned a lot since then. So what I did was I put together a PowerPoint, if it's okay if I share that, Tess. Can you give me rights to share? All right. Can everybody see my screen? Cool. So, a little bit about me. My name is Chris Patille. I am a regional manager here at Cross Country Mortgage, which means I'm licensed in lots of states and I have lots of offices in lots of states. So, the topic of today that I'm going to talk to you guys about is renovation mortgages. And the reason why I think these are so great is because there's a huge misconception that goes into reno loans. And number one, how to qualify for them. How do I pitch this to the client? How is the seller going to accept this? And my goal by the end of these, I think I have 97 slides, Tess. You said I have about 3 hours tonight, right? All right, so we'll keep it short. But by the end of these slides, guys, I'm going to be able to explain all the benefits of the product. I'm going to go through all the available Reno products, and then at the very end, I'm going to talk about some hard money fix and flip, and then I will get into all of your Q&A. So bear with me as I operate this PowerPoint. All right, so what is a renovation loan, right? Very simple. It allows you to purchase the house or refinance the house, and it allows you to finance the cost of the repairs into one loan. So, couple benefits there, right? The loan to value is going to be based off of your purchase price and all of your renovations itself. It is not, here's what we're paying for the house, and then everything else is on top. It all gets bundled into one loan, which is great. Makes it easier for the client, easier for you guys when it comes to closing, and obviously a lot easier for the contractors as well. Speaking about contractors, when doing one of these programs, the borrower or agent are able to recommend and choose their own contractor. We will vet them on our side to make sure that they're all on the up and up and they're not going to run away with all the money, but they are able to choose somebody that they know, trust, and have used before. Very, very, very big part, and this is what I kind of urge all real estate agents when you're showing homes, especially one that would probably fall into the wheelhouse of needing a 203K loan, is we're going to need that scope of work in order for me to do my best work and crunch all these numbers for the borrower. So basically, what that means is when you're showing the house, it would be awesome if that client's contractor was able to do the walkthrough with them so that everybody's on the same page with how much these renovations are going to cost. I would say 10 out of 10 times when I have these conversations regarding a reno loan, they're like, yeah, it only needs about $30,000 worth of work. And I'm like, all right, cool. Explain that to me on what you're really looking at to get done. Well, we need a new kitchen. We need two new bathrooms. It needs new flooring. It needs new paint. It needs the whole nine. That is definitely not $30,000 worth of work. So it's great to have an estimate right there, but we really want the professionals to come out and be able to quote that for us so I can do my job, make sure that all of this is within their budget to qualify and to make sure that this loan actually closes, right? My goal is to give you guys more loan products to put money in your pocket. The other benefit, right? How many times have we gone through a house and we're like, this will never pass an FHA inspection? Probably a lot, right? There's always peeling paint, broken windows, exposed wiring, leaky plumbing, rotted drywall, mold. All of these things can be incorporated in a 203K loan. So definitely when you see a property like that and you're like, look, the client wants to do renovations, this is definitely a awesome product to be able to use. Other benefit is the renovations start after settlement. So what's that mean for you? That means we're going to closing in that normal time frame. Now, I do tell people that sometimes working with contractors, they may be a little slow. So I always try to schedule these for about 40 to 45 days just to give that contractor enough time to get all the paperwork in, review the scope of work with our team, obviously the appraisal. And the benefit there is all of the actual work itself is going to happen after settlement. So we're done. Our hands are clean at that point. Everybody's paid. The client owns the house at that point, and then the contractor is able to get started. Common misconceptions about renovation loans, right? Most people just don't know the product itself. They don't know how it works. They don't know the time frame. They don't know how to sell it to the client. And in my opinion, the biggest fear is normally, representing that to the seller. If you have a pretty straightforward property that's in great shape, yeah, it's probably going to be hard to sell a 203K loan to that seller saying, hey, we're going to close in 45 days and they're going to do a boatload of work on your property. Now, granted, you're also going to have your properties that are dilapidated, right? You're going to have the houses that are run down. You're going to have the houses that need a lot of work. And this program is absolutely fantastic for that. Those sellers, those listing agents, they're going to understand that, hey, if I'm not getting a cash buyer on that deal, I'm probably not getting a straight FHA loan. I'm probably not helping a veteran on this property because it has a lot of deferred maintenance or it needs a lot of major repairs. Good news is we've got multiple solutions for all of that, right? Like I said, property's outdated. The listing content is missing out, just saying, hey, cash only, because it knows no appraisal is going to be able to go through there and get qualified. We talked about the home not qualifying for traditional financing. How many times have we seen our sellers who just don't want to make any repairs, right? They're stuck in their ways. They don't want to deal with, painting or updating the kitchen, demoing the bathroom. This program helps with all of that. And not only does this work with purchases, but you can actually do this if you already own the home as well. So it is absolutely great to do this as a refinance. You get into the property, you're like, you know what? The missus doesn't like the kitchen. She's not cooking as well as she used to be. I need to give her a bigger kitchen, right? Great product for it. Same thing to update bathrooms. I've seen roofs, wells, septics, at pretty much anything you name, and we'll go through the specifics later, is able to be included in this renovation products. So boom, here we go. You guys can see some of the available property types, right? We're hitting all your single family homes. Any multifamily up to 4 units, we're able to renovate, which is great. Second homes, right? Who wants to buy that beach house or buy that summer house down the shore, but it needs work? It's been sitting on the market, really hasn't had any love, needs some repairs. The other big thing, which I think kind of shocks a lot of people, is you can do a renovation loan on a single family investment property. So who out there may be doing, flips, maybe doing buy and holds. We'll kind of get into some hard money options later. But if you were to use a straightforward one of these mortgages, you can do that on an investment property. Lisa, I'm showing you raised your hand. Do you have a question?
Yes. So
Fire
I
away.
saw on the previous slide you had there regarding the
That
buyer.
one?
Can you hear me?
Yes.
Oh, okay. Where is it? It has about the buyer finds their own contractor.
Oh,
And
that was that one.
yeah, this one, yes.
Okay.
So now do you have to give approval of that contractor who's going to be doing the repairs of the renovations for that loan?
Yes. So part of the process on my side is my goal specifically, right? Me as the loan officer that's working hand in hand with you, hand in hand with the client. I'm working on everything as far as getting them qualified for the loan itself. Debt to income, credit, assets. I'm working with you on the property. I have a liaison in our Reno division that they call it here at CCM who is going to work specifically with the contractor. They're going to get all the W-9s. They're going to get the scope of work from the contractor. They're going to get their proof of bonding and insurance. So they're going to go through and vet these contractors out to make sure that they are who they say they are and that they're able to perform to do this work. I literally had this about 2 months ago. A guy wanted to do a reno loan, gave me the contractor. Guy wasn't licensed, wasn't insured. The guy swore up and down, Chris, I think his name was Jeremy. Jeremy does excellent work. I've seen a bunch of his products. Our team got involved. He had three, I guess, liens placed against his business for work that he didn't complete and that he owed clients on because he wasn't doing things on the up and up. So I had the unfortunate job of sharing that news with the client, and he said, "Chris, you probably just saved me a couple hundred grand." So we are very diligent in the documentation that we do request, and that is only to protect the client.
Thank you.
Sure. All right, so we talked a little bit about the property types that are eligible, right? This gives just a brief synopsis of kind of what renovations particularly we're able to work with, right? Talks about the new kitchen, obviously new bathroom, new roof, new HVAC. We talked about the well and septic, adding a second story to the existing house. That's a whole roof raise right there. I mean, that's normally a couple 100,000 depending on how you chop it up, but that's a very big renovation in my mind. So let's say you have that perfect lot, that perfect house that has great structure, just not big enough, right? This loan can use it to be able to raise the roof per se and add, call it double that square footage. I've seen people build detached garages with 203Ks. I've seen them construct an ADU, which is basically another accessory dwelling where somebody would reside on the property in a smaller fixture. It can be used for landscaping, which is great. Mold is a big one. I have unfortunately come in contact with a bunch of mold on some of these transactions, and it literally is able to remediate that. I've seen foundation work where the foundation is cracked and they need to put, anchors into the soil, pulling the wall back because it's past a certain degree. All of those things are able to be used in this loan program, which is great. And then who doesn't love a good pool? It's summertime. Everybody wants to be outdoors. It was absolutely gorgeous today. I was out there working on my tan for a couple hours, taking some phone calls. Who doesn't love a good pool? This is a great program to do it, right? How many times are we talking to buyers where they're like, you know what? This is the perfect house. Where do I put a pool? Most people are going to be like, yeah, just, talk to, AquaWorks Pool or, whoever's doing it and they'll figure it out. This is a great option to be able, even if they don't use it to purchase the house. Remember, we can do this for a refinance as well. So this is giving you, the agent, more tools saying, hey, why don't you talk to Chris across country? I believe he has a program that you can actually use to finance the pool into the mortgage. I can tell you because I bought a pool before. It is very expensive and it does cost a lot of money. Having a 14% interest rate on a loan like that is way higher than rolling it into your mortgage. So, definitely a good option to be able to use. Like we talked about, the reasons why most agents aren't using the program. They either don't understand it, they've had a bad experience in the past. I've definitely had one of those, so I can't knock that. And they just don't know where to start, right? They haven't had somebody sit down going through these 97 slides with you guys showing all the ins and outs of the program. So let's talk about the pre-approval process, right? This is what I do on my side. So we have to know what your estimated renovation budget is before we write that offer, right? We talked about having the contractor walk through. We talked about having a pretty good estimate before you're actually writing that offer. Last thing I want to do is have that client pre-approved for, let's say, $400,000. The house purchase is 320. Everybody's thinking in their mind that, okay, the renter's probably going to be 60 to 80 grand. And then boom, all of a sudden it's 150,000. And now we're 60K over budget, right? That doesn't really help anybody. And it certainly doesn't put you guys in a good position. So I definitely do my due diligence about that, and I will harp 100% on the client and the agent. Did you have a contractor walk through? It is imperative that we do that so I can keep everybody honest and I'm not pre-approving somebody over their budget. There's a lot of things that are included in these loan itself, right? It kind of breaks it down a little bit. We have our hard cost. That's going to be all the labor and materials from the contractor. We've got all the soft costs. That's all your plans, your permits, your reporting. That has all your interest built into it, all of your renovation fees, your title work, your inspection fees. There are two appraisals. We have one appraisal up front, and then we do have a second appraisal, which gives us the ARV, which is the after renovation value, which is going to show us and make sure that after they do all this work, the house is actually worth what they're buying and what they're putting into it. The goal of this program really is to kind of open up more options for you as the real estate agent, right? You see these houses out there, you look at them when you're sending them the MLS search, and it doesn't check all of the boxes. You yourself know, hey, this is probably a good house for them. It's got great bones and it's in a great area, but it just doesn't have all of their needs. So, granted, we've all had that one client that's been looking for 2 to 3 years. We can't find anything to be able to help them. This is sometimes a great product that we can use to kind of open up those additional doors that might have been normally shut. Now, is it the easiest program? No. Is it a lot of work? Absolutely. Do they close? Always. Tia, you got a question? Hit me, girl.
Yes, I do. So I just want to confirm because I'm looking at the first part here. So if they're pre-approved for the 400,000 and the property's 300,000, that only leaves them with 100,000 for renovation.
That is correct. Yes.
So
And
you're
that,
so
yeah.
no, I was going to say, so no matter, I guess, whatever property you're trying to buy, and I guess that's what's always kind of confused me. I thought it was like you get pre-approved for whatever amount, but that didn't necessarily include the renovations. So that all that has to bundle into whatever. So if you're only pre-approved for, let's say, 150,000, then you're kind of,
You're
you don't
kind
really
of
have
cooked
much to
at
play
that
with.
point, right? Because you're going to have to find something that's for sale for 80 to be able to put 70 into it to keep it
Right,
under
right.
that 150,000. Now,
Okay.
if I know that the client is looking for a renovation loan up front, what I'm going to do is I'm going to curtail everything from the very beginning into saying, hey, I know they want to do a reno, right? So I'm going to give you, the real estate agent, their max budget. Hey, I don't want you coming anywhere close to this, but if we get there, please, please, please keep them under 400. So then if you're like, hey, Chris, I got them a property at 220, that gives us a decent amount of leverage there in order to find enough renovation to be able to make this work. Then I'm going to give you the green light. Hey, that does fall under our budget. I'm okay with you moving forward with that.
Okay. Nope, that makes sense.
Yeah. So I'll try to do all of that conversation work prepping up front. If it's on the other hand where it's like, hey, we're under contract and the home inspection comes back bad, right? I've seen that a lot. I've flipped loans that were in process for a normal FHA purchase, 3.5% down. That home inspection comes back terrible. Flip it to a 203K. We already have the inspection report. I give that right to the contractor. He gives me a quote. We order the second appraisal. We're not skipping a beat at that point. So there's multiple ways to kind of leverage the program. It just depends on whether we're proactive up front or whether we're just reactive after we already got the home inspection back.
Perfect. Thank you.
The way that I try to use these programs is I try to use this as like a saving tool, right? You got that one client that just doesn't like anything you show them. Boom. Hey, why don't you talk to Chris about this program? He's going to go over some different options with you on how you might be able to find the home that you most like and turn it into the home that you love. Because at the end of the day, I'm trying to put more business in your pocket. If I give you more loan programs in your toolbox and you're out there showing houses, you're going to remember, oh, yeah, I remember what Chris said on Tuesday about we could put a pool in or we could do a detached garage or we could do this, that, and the third, so that that client is going to be like, you know what? That's the program for me. I actually do like this house and I do want to take it to the next level. Lisa.
So question. So I have a house. I have a place I would have to, but I want to get a house that I know it may have to get some renovations, but I know I won't be able to move in it. So how does that work when you do have to still be paying two mortgages until the house is completed before I can sell this house, or how does that work out? So,
So I would work, so that all comes down to debt to income ratio, right? So
okay.
when I'm doing your initial pre-approval, Obviously, if you're buying a house that needs reno, you're 9 times out of 10 going to stay in your current house. So I would just include your current mortgage into the debt to income ratio. And I would say, hey, with keeping your house,
Mhm.
here is your max budget, X, Y, and Z.
Okay.
Then I would say, in the odd event that maybe you're buying a house that you can still live in during the reno, or maybe you have friends or family that you can stay with, I'll say if we sell your house, here's what your max budget is, and that would be the total amount. So obviously that amount's going to be higher, but I would always structure that both ways for you so you could see it how it's broken out. And then you could tell me, hey, Chris, that works, or no, Chris, that doesn't work. And then we could start to work together to find out an option.
Okay.
I've had people live in campers while they're doing renos. I've had people live in hotels. I mean, I don't know. I've been doing mortgages for 15 years. I've probably done 3 dozen of these in my career. I've seen some crazy stuff happen for sure. Like I said in the beginning, my first one did not end well. It was for a client down in Florida. She was doing a whole new HVAC because she bought the house and she knew the HVAC needed to be repaired and wanted to include air conditioning. Why they didn't have central AC in a house in Florida, I have no idea. But long story short, the contractor didn't like the draw schedule that us as the lender had set up, and he wanted like 95% of the money up front. So long story short, we told him in the beginning with our, construction liaison, like, hey, it's broken down into 2 pieces. You get 50% up front. When the work's done, you get the rest. So he didn't install anything because he wanted his 90% up front. And I said, unfortunately, my friend, that's not how it works. You signed on this paper. So he tried taking us to court. We ultimately won, but the client wasn't too happy about not having AC because, again, the loan closed and all of this was happening like after the fact. So it was a little crazy. But everything happens in mortgages and real estate. There isn't anything that shocks me anymore. All right, so let's keep this rolling. So a lot of people just search on Zillow, right? 9 times out of 10, if they're not looking at your MLS, they're on Zillow. Something like this in good old Dallas, Texas pops up. Boom, 135K. What do you guys see? I don't know about you. I'm seeing boards over the windows. I'm seeing overgrowth as far as landscaping. You got the retaining wall falling down. I'm assuming the gutters are falling off the house. The roof looks terrible. Then you start looking inside. It's a mess, right? That may be in a great area. Maybe the ARV's 300,000 on that house or 350. And it may need a solid 125 worth of work, but maybe you're getting that sweat equity of 50 to 80,000 afterwards. The other thing is how much equity are you building after the renovation that you're completing? This product is more designed for the homeowner, not so much the investor, but I've seen it done both ways. So this one right here in good old Dallas would definitely be a good candidate for a reno loan. You're taking a look at all the things wrong with this house. All of these things can be fixed. The flooring, the windows, the interior drywall, the kitchen needs a little bit of love. I don't know about you. I'm not making any sandwiches on that counter anytime soon. All right, so we talked a little bit about writing the sales contract, having to have the budget so that we can get the total acquisition cost. This is just really here to kind of show an example, right? $300,000 purchase price, $100,000 reno. You got a 400K total acquisition at 96.5% LTV, which is 3.5% down. Boom, that's your loan amount. It shows it for the VA and the USDA version, and then it shows it for the HomeStyle, or I believe it's Home Possible for Freddie Mac, their style as well. So to answer your question about down payment, because this is a good slide for it, FHA, you're putting 3.5% down on this program. VA and USDA, it is 100% financing. How many veteran clients do you guys have out there, or how many clients do you have looking in that rural area that the house just doesn't work? Boom, this is a great product for that. And then obviously you have your conventional. With being a first-time home buyer, you can put 3% down on the conventional side and be able to purchase that house. If you're not a first-time home buyer, the minimum down payment is 5%. All right. So we talked about a couple of the benefits, but obviously the big one, right? Taking advantage of all listings. Obviously you're going to have your properties out there where it's got to be a cash offer or to be competitive, but anything that's run down, anything that's aged on the market, this is opening up new doors. And not only are you helping your buyer, guys, you're helping the listing agent as well, right? How many people list that house just hoping for somebody to come through? Maybe they don't know the loan programs that exist. You might be able to take them and say, hey, I have a client that's doing a renovation loan. Your property's perfect for that. My guy can get this done in 45 days and it's out the door. Those are huge benefits, not just to your buyer, but to your listing agent as well. So we talked about the down payments, got that. See, I'm just ahead of the game. Borrowers making fully amortized payments. Yep. We talked about, okay, so the interest rate is always fixed, right? Always doing fixed rate loans, which is great. Um, It's one of the benefits. A lot of people think it's like a construction loan where it's a 12-month term and then you have to refinance afterwards. That is not correct. This is one loan that does the whole thing. So it does not have to be refinanced afterwards, which is huge. And again, the borrower's making fully amortized payments like a traditional loan, not an interest-only payment. This kind of breaks down the individual loan types for Fannie Mae, for Freddie Mac, for FHA, and it basically goes down and says, hey, here's the minimum credit scores. So for the 203K products, and they actually just lowered this, the credit requirement before was a 680. They dropped it down to a 600. And guys, I will send out this PowerPoint so you guys have it because I know this is probably really hard to read. But it basically breaks down what the loan to values are, what property types are eligible, which we spoke of, what the credit score requirement is, whether you can tear it down or not, whether mold remediation or additions or foundation repairs, all those things are included. Sharice, what you got, girl?
Hi, just a quick question. Just you literally just said, I just want to make sure I heard you correctly. For the
Sure.
credit minimum credit score is lowered to 600. That's for FHA, conventional, all of it.
620 for conventional, 600 for FHA.
Oh wow. That's better than I'm okay. Never mind. All right, thank you.
We aim to please here at Cross Country Mortgage. What can I say?
Just kind of off topic, but what would be your minimum for a regular FHA, 9203?
So if we're going just a straight up FHA loan with no DPA, we can go down to a 580. If the borrower has some money, we can do a 10% down and you can go down to a 500. And
Oh,
it doesn't have to be an approved eligible. We can do a manual underwrite on that.
oh wow. I might have to talk to you aside on the side and pick your brain a little bit just about
Absolutely.
some
I'm
of
happy
your
to schedule
products.
a call with you. We can sit down and chop it up and I can answer any question for you.
Thank you.
So
Absolutely.
I have a question.
Go ahead.
So what about somebody has land, but they want to build a house? Was that a different type of loan altogether then?
So that's going to be a new construction loan.
That's a new
So
construction
to
loan.
touch a
Okay.
little bit about that, we do have a whole construction division as well. There's three different types of construction programs. You have new construction where the builder is financing the build. We're basically paying them off at settlement. We have a construct to perm, which is where the builder would request draws, right? So they're going to say, we're going to do a foundation draw. We're going to do a, sheathing and walls and stud draw. We're going to do all the mechanical draws, plumbing, electric, roof, etc. And they're getting paid periodically to build the house. So that's the one I was speaking about earlier, where the construction loan lasts for 12 months.
Hmm.
Once the house is built, we refinance to get back into a traditional mortgage to
Hmm.
be able to move forward. The other one of those loan products that we have is it's called a one-time close. That's basically where you can use the loan to buy the land and to build the house. It funds one time up front. Builder gets all the money. There is no draw schedule for that. Builder gets all the money up front. They're able to build the house within the time frame that was negotiated, and client gets their house. Done deal. So Construction loans are great. There's so much that goes into it. There's like this is a lot of work. Construction loans are a lot of work because you got to deal with builders, you got to deal with permits, specs, perk tests on the land, make sure there's public utilities that are running to it. That's a whole different Tuesday night conversation. We'll see if Tess will invite me back for that one.
I think we can probably do that.
Appreciate that. All right, so we talked about the different types of loan programs, right? We talked about the USDA, we talked about the VA, we talked about the 203K. Now, there's two types of reno loans. There's limited and there's standard. Limited reno is going to be a budget under 35,000. With this product specifically, we do not need a second appraisal, which is great, so we save a couple bucks there. And it's a little bit of a shorter time frame because there's not as much work that's going into it. Now, you're going to have your standard, which is going to be anything that's over 35,000, right? And there's different limited and standards for each different program. You got your USDA, you got your VA, and you have your FHA. So the good news is there's a budget for everybody, and there's a way to do a large amount of repairs on either one of these loan programs. I think one of the most common questions I have is, Chris, what's the limit? The only time I've been told no is when the renovation is worth more than the house. So if you're buying a house for 200,000 and you're trying to put 200 in it, but the house is only worth 375, that's one of the times that we're going to say no. And we're going to say, hey, the ARV doesn't meet the amount of work that you're putting into it compared to the comps in the area. So then we would say, is there a way that you can work with your contractor to be able to redo your budget? Tess.
I'm so glad you brought this up because I don't know if I missed it earlier and I had to take that phone call, but in the very beginning, whenever someone on this screen comes to me and talks to me about reno loans, before I let them call you and bother you or get excited or get their clients excited, I'm like, we need to run comps. We need to run comps in its current condition, and we need to run comps for when it's brand new renovated. And if there's not enough margin in there, we're not doing this right now. Because if they don't do that ahead of time and we find out after the client went and got approved for this beautiful reno loan and they fell in love with the dream,
Spent a lot of money at that point too.
spent way too much money, way too much time, and now I have very heartbroken clients
Right.
that are looking at the agent like, why'd you let me get this far? And then I got to explain how, well, I'm very sorry. And I don't want to do that. So before you get, because some people they think a lot of consumers feel that they can find any house and maybe they don't like the way it looks, even though it's just been brand new renovated. They think they can get a reno loan to redecorate essentially and do cosmetic stuff. And I'm like, no, 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 because it's brand new renovated and the value of the house is max for the neighborhood right now. So
Correct.
if just because you don't like the finishes that were chosen, you don't get to get a reno loan and have somebody in finance changing it. So you got to make that very clear. So you want to figure that out before you have contractors come out, before you have this or that. Like, I'm gonna be honest, if there's not like a good, I like there to be 100 grand to play with, depending on the size of the house. Most of our Philly specials, I'm gonna say maybe 75. And if there's not at least that amount between the comp at its condition and a brand new renovated, we're not talking about a reno loan. It's too close. And I don't trust the contractors to not F us over either, right? So that's just like my little guide for wanting to use these products or not. It's a quick and easy one, so you can nip it in the butt or know that you can move forward ahead of time.
I agree with that 100% because you
All
got to
right.
realize, we've got a third party appraiser, and how many times do appraisers throw us curveballs that we can't see coming on normal deals,
Bruh.
much less putting together something that, hey, here's what it is right now. Here's just a list of what's going to be done. The contractor really might not know the in-depth finishes that you're going to be doing on that property. So, right. I definitely always tell people up front, we need to do our due diligence on my side as the lender, on your side as the real estate agent, to make sure that this fits, right? Like we got to be looking for houses like this because this thing, right here, dirt cheap at 134. And if it's in a good spot, if you're getting that 300, 350 value, this is definitely going to work for you. Sharice, another question.
Yes. Are the grant and assistance programs available for these types of loans? Because
They go
you
back
say
and
a lot
forth.
of out of pocket upfront and out of pocket, which upfront is always a thing, obviously. But what about grants and
So the biggest really money add up front is going to come into where did I lose it? Oop, wrong one. Struggling. Where did it go? Got it. One second, guys. There we go. Okay. The most money that you're going to spend up front, right, is going to have to come around your appraisal. Obviously, that's going to have to be paid up front. That goes right to the appraiser. And then obviously a home inspection. Now, to answer your question, some programs do allow for to use a 203K product. There's also a lot of programs that don't involve using the reno. And the reason that the answer is no with that is comes down to number one, the appraisal, but it comes down to the time in which the renovation is completed. For example, when I do a PHFA loan, right? I have to sell that loan to PHFA within 45 days of me closing, or I technically get charged an extension fee on that money. So a lot of the down payment programs, your PHFAs, if you're in Delaware, your Delaware State Housing Authority, they all did them back in the day, but they don't really like doing them recurrently because of the time constraints. And to be honest with you, just problems with the contractors. The biggest thing that comes up on these deal guys, and we set aside contingency money on this, is the repairs come in over what it's quoted, right? I've seen it time and time again. We do the reno budget at 75K. He's got a 10% buffer on it, so we're at 82.5 for a reno there. And then boom, the actual repairs come out to be 90,000. So now you're going back in trying to tap into that loan to increase the budget and find out, all right, are we lowering what we're doing with the reno to make it work? Or are we going to ask the mortgage company for more money? Is the client going to contribute the shortage? There's just a lot there, and a lot of times the DPA programs just have an issue with that. I have seen the grant programs be a little bit more flexible with working with that, but what I always tell everybody up front, if we can find a DPA that works, that's kind of a miracle, but 9 times out of 10, that's going to be a completely different program. So if you have a client that just doesn't have any money saved, right? I literally was speaking with Lanique today on our client Carmen because they had given me two houses, one for a 203K and one that they needed PHFA for because we were using the grant. And I looked at the one for the 203K. The purchase price already was over their comfort zone as far as where they wanted their monthly payment to be, not even including the renovation. So after running all the numbers, I said, look, that one's not going to be our best bet. You only have $800 to be able to use towards your purchase anyway. That's probably not in your best interest. Let's go with this property over here. So my goal on my side is to kind of weed out, the programs for that client. This loan is not for everybody,
no?
right? It may not get accepted with the listing agent and the seller. It may not fly with the appraisal. It may not fly with the contractor. So it's my job to kind of guide us through that process as best as I can with all of these different factors that we have to take into account. That's why
No.
I tell everybody up front, give me 45 days. My goal is going to be to close it in 30, but I'd rather me set the right expectations up front and you guys know, hey, it's not Chris's average 2 to 3 week turnaround. It's going to take a little bit longer. That way, we're all on the same page and you guys can reiterate that to the listing side.
Okay, and I'm sorry, I just want to make sure I understand the process clearly. So in your example that you gave, The purchase value I think you had was the pre-approval was 400,000. The purchase price was 300,000. So that left 100,000 budget for the renovation. So let's say everything works out fine, papers get signed, we close with that scenario. And then the renovation, let's say, surprises you and so now before I even get to that part, so now the customer or the client, the home buyer, is paying a mortgage based on that 400,000 or that 396 or whatever that loan for that amount. But then the renovation is done and it comes back lower. So they didn't use the full 100, they only used 80. Do you then automatically like redo the loan and get the lower payment or give the money back, or like how does that work?
I normally try to treat myself to a nice bonus at that point. I'll normally take my kids on vacation, go buy something nice, and nobody will be the wiser. Kidding.
Oh,
So they do a principal reduction for the amount that was not used, right? So in your example, let's say it's 20,000. So that mortgage at 400, after all of that finalizes, they say, "Hey, we got $20,000 left in escrow." That money is then done as a principal reduction on the balance remaining of the mortgage, and then they will allow that to re-amortize to lower the monthly payment. So all of the money gets used one way or another. And
okay.
to be honest with you, most of these budgets do come in under. I would say 9 out of 10 times the
That
budgets
doesn't
do come in
happen.
under. Sometimes it's a couple $100. Sometimes it's a couple $1,000. But the money does come off of the loan so that the client is not paying interest on funds that they haven't used.
Okay. Thank you.
Of course. All right. So this kind of breaks down the FHA version, right? We talked about it, 3.5% down. You can do a 1 to 4 unit. It is a 30-year fixed rate. We can gross up some of the value with the appraisals, which is great. We talked about the renovation limit. For this one, for a limited, it's under 75,000. Granted, that just updated 2 years ago. Back in the day, that was always 35K for a limited. So that means that more people are using this product, doing a higher renovation value, which is why they're updating these and making these, updates to the program. The big thing that also gets asked is what is the minimum amount for a 203K? Now, granted, this says $5,000. I will never put the client in a reno loan for 5K. It's not worth your time. It's not worth my time. It's not worth their time, right? There's so much work that would go into a $5,000 reno. I would tell them to go to their bank, get a personal loan, save some money, take money out of, reserves and savings before I would structure a loan with a 203K with a $5,000 reno. I don't even know what you would do for that. Maybe flooring and paint, maybe flooring. I don't know. Everything's so expensive these days. So it's like, how are we really going to get, all of that in there? But there is a minimum, and that is 5,000. We've got lots of cool flyers. I printed off about 5 of them before the meeting. So what I'll do is I'll get everybody's contact from Tess and I'll just shoot you guys over all the renovation flyers that we have, and I'll send you over this presentation as well. So we talked about the conventional side, right? 3% down if you're a first-time home buyer, 5% down if you're a repeat buyer. We can do it up to 4 units, which is great. Almost no restrictions on the conventional side for improvements, cosmetic, structural, non-structural, whatever works. Luxury items allowed, pools, backyard gazebos, outdoor kitchens, pizza ovens in your backyard, all of those amazing things. All improvements must be affixed, right? So you can't use it to buy a couch, meaning that anything that you can take with you, you can't use for the reno loan. We did talk about this, but you cannot use it for a tear down and reconstruction. That would be a new construction loan. That would not be one of these renovation products. Talks about the ADUs if you want to build a little shed in the background, to be able to live in, or maybe you're putting a significant other in if they're not acting right. can definitely do that to build an ADU as well. Tess is laughing, but she knows what's up. Same thing. They bought the perfect house, but they wanted a pool. I would say probably 10% of the 203K loans that I've done are actually revolving around the outdoor space and wanting to kind of make it more home to them. The pool is definitely probably one of the biggest things because if you're getting a pool these days, I would say your minimum 40 to 60 grand on the light end, probably going north of 100 if you're getting a house like this. This pool is probably 80, 90,000. So having a loan program like that is absolutely fantastic. USDA, I know we don't really dabble a lot with that in Philly, but obviously, if you're out in the burbs somewhere and you're starting to head into the country, we've got a program for that as well. Talks about all the different things that this one covers, which is great. The VA one. So I like the VA renovation loan probably the best because obviously it helps our veterans. But it allows you to do all this with 0% down out of your pocket. So that to me is huge, right? It's if you got, and first of all, everybody knows the VA appraisals are just so much fun, and we know our sellers love them, right? We know the listing agents get a field day when you see that VA pre-approval, and then you guys have to sell it. Hey, this person served our country. They're interested in your house. Please give them a shot, right? Well, if you got a house that needs a bunch of reno, boom, we have the perfect program for it. So the VA renovation loan is absolutely fantastic. So again, my main goal, how do I increase your business? How do I put more money in your pocket so you want to pick up the phone and call me more? The answer to that is easy. Open up more properties for you to show, right? You guys are always going to see that house that checks the boxes in the neighborhood, but the wife doesn't like X, Y, and Z. Boom, we got a program for it. You know, any of those properties that are listed, fixer upper, maybe you have a set of investors that are looking fixer uppers, boom, we got a product for it. There's so many different loan products that we can use with it, conventional FHA, VA, USDA. So it's giving you more tools in your toolbox when it comes to converting those clients. It says, brand yourself, one of our slogans, brand yourself as an agent who will offer the most exposure a seller could ask for, no matter if you're on the buy or sell side, right? It's a fantastic quote. I wish I would have written that. All right, so we talked about the flyers. I'm going to swag you guys out with that. We actually have co-branded renovation flyers. So if anybody would love to co-brand marketing with me, I
That's the
can
ones you're
actually,
gonna want. That's the ones they're gonna want.
they're going to want the co-branded Johns?
Yeah.
Okay.
And
So what
now
I
you
can,
wait after I done asked for flyers for months now.
girl, what you been asking for?
Flyers, all those events I've been going to, handing out your flyers with just your face on it.
This just came out yesterday, Lanique. I was going to tell you about this earlier, but we wasn't able to get on a call.
Ooh, somebody said
Email, my friend, email.
You just talk to my assistant. She'll get those over to you by midnight tonight. I promise. I'll put her on that right now. Actually, Lanique, I will send you the invite tonight so you can log in and see this, and then you can go through and look at all the flyers, like everything. There's like 10,000 pieces in there. So I am writing myself a note. Invite
You know
Lanique.
I was only playing.
Girl, I know, but I can't not back it up now because then you just think I'm talking smoke.
Thank you.
I will
Tess,
send
I
you
can
the
just see
invite
you
tonight.
laughing, Tess.
Tess always be laughing. So it talks a little bit about this is just different marketing stuff that we do for these renovation products if you're on the listing side, right? So when you go into my marketing portal, you guys can build single property websites. Obviously, you're doing all of that when you're putting it on Zillow, Realtor.com, Homes, everything else. But this does have a couple different marketing variations with which I think is, very resourceful for. Um, this is a little bit more about how the draws work. I always give one of these to the contractors so they know the do's and don'ts and what to expect. That way, there's no questions, right? My goal is transparency. I want you guys to know as much as possible so that you can educate the clients, I can educate the clients, and we can have a seamless transaction. So we talked about the milestones, right? We want to get pre-approved. We want to get the numbers in for the build. We want to submit that offer. We want to make sure the timing works for the seller, the contractor, and us. The other thing is making sure the timing works for the contractor. You may have to interview 3 or 4 contractors for one transaction because maybe one's, booked out till September. We don't want to have that client be in this house without renovations for 6 months. So it's definitely something that you want to consider as well when we're sitting down interviewing the contractor and things like that. We talked about the closing process. Very easy as always. It's once you're past the reno side where all the appraisals and everything else are approved, it's just a normal mortgage transaction. It's the same title company, it's the same set of documents, it just has a different packet specifically for the reno side of things. Now, before I go into the Q&A, I'm just going to give you a little teaser on some hard money stuff because I've been dabbling with it recently. So we have a fix and flip product, which this is obviously more for the residential side of mortgages for the buyer that's going to live there, right? The fix and flip that we have is more for your investor, your flipper, you're somebody that has an investment portfolio that's trying to add on it, right? So we have basically a hard money program that you can put 10% down of the purchase price, and we will finance 100% of the financing. Now, with being a hard money loan, obviously you have strict terms. You have a 12-month interest only payment on the amount of money that you have drawn so far, and you have a higher interest rate than something more on the residential side. We're normally seeing interest rates anywhere between 11 to 12% on these products, with normally about 1 point upfront in origination. So if you talk to your investors, ask them what they're getting on the street. From what I can see, I just did it myself twice in Ridley and picked up 2 houses. It was the cheapest money I could find, and I've been doing this for over a decade. So I've got a great Excel sheet. I've got a great application specifically for the hard money side. So we're using the renovation products with CCM for all of our residential customers that are moving in that are going to live there. And then all of the investors, I have another side where I'm offering the, bridge loans, fix and flips, and things like that that make the most sense to buy that property, renovate it, and then I can show them how to refinance out using a conforming mortgage or a non-QM product in order to build wealth. So I've taken up 59 minutes of your time tonight, so I will open it up now to a little Q&A, and I'm more than happy to answer all your questions.
Did you say that the interest rate for these loans where normally right now my clients are seeing about like a 6, I don't know, 5.8. I think I had a client, and then to like 6.5. You're saying for these type of loans is 11%?
So that's the hard money that goes up to 11%. If your client's getting like a 6.5 or a 6.8 on an FHA, call me because we're about a quarter to 3/8 of a point lower. But the normal rule of thumb that I tell everybody for the reno loan, it's anywhere from 50 to 75 basis points higher. So if you're at a 6.5 on a normal loan, it would be no more than 7.25.
Oh, okay. For the
That's for your
mortgage part,
203K, your
or
VA, your
for,
conventional, your USDA. Correct. It's
well,
normally
I'm
about a
sorry,
half to 3/4
this
higher.
might be a dumb question, but when you say the 11% is for the hard money, what you might have said it, I should know, maybe, I don't know, but
Okay.
what is considered the hard money? Like what, like in that
So,
example with the 400,000 pre-approval, the house
so
was 300. You're
I'll
on
just
mute,
give you
guys.
my example, right? So I just did hard money myself. I bought a twin in Ridley. My purchase price for both units was 360,000, right? So I paid 180 for each unit. My
Okay.
reno budget on one of the units was about 45,000, right? So that puts me at a 225 all in amount, my purchase price and my reno. Just talked to one of my agents and they're listing the house next week for 325,000. So I stand to make after realtor commissions probably damn near on 75K on one of the flips. So the
Nice.
hard money is different than a conforming mortgage. Everything that I showed on the PowerPoint is a conforming mortgage. All your
Okay.
conventional Fannie, Freddie, FHA, VA. Hard money is basically like the Wild Wild West. If you have a pulse and you know what you're doing and have an okay credit score, I can get you set up for financing for properties that are going to need rehab. This is normally all of your investors and flippers out there who
Okay.
are going to not want to use their own money to buy. They're going to take that hard money, which is basically a short-term loan. They're going to buy the house, do the renovations. A lot of them may be contractors themselves. And then afterwards, they're either going to refinance that into a buy and hold, and they're going to keep that as a rental property in their portfolio, or they're just going to sell the property, pay off the hard money debt, take their profits, and then rinse and repeat.
Oh yeah, I remember reading about that in real estate school. Okay, I'm sorry. I just haven't worked with it. So
You're good.
it was out of mind. I forgot. But once you started explaining it, I do remember. Yeah.
Cool.
I have a question. Now, going back to the part with I seen properties that they're cash only. You said you can work with those too?
So basically, the hard money is a cash loan, right?
Okay.
I tell people 7 to 10 days, I can get you money there for a purchase like that. It's not going through the normal underwriting processes and things like that. You still need title work because obviously there's transferring of deed, transferring of ownership, but it is a much faster process.
Oh, you know what, Tess? The listing I had last year, I think I probably didn't realize it at the time because I was on the listing side, but I think my buyer did this because they came to me as if they was an investor with like a cash offer, but they really were getting like a loan, but it literally
Yes.
happened in like 5 days, like you just said.
Yeah, so a lot of times agents will submit offers and say that it's a cash deal because they think hard money is cash, but that's wrong. And so when you're on the listing side, you have to correct that because there is a ton of hard money lenders out there and they will tell someone, a potential buyer or their agent up front, like, yeah, we'll give them the money for this. You'll get under contract and you submitted a cash offer in which was wrong to do. You still is financing. You have to say what type of financing it is. The only offer that is cash money. I mean, they showed a proof of funds and they have the funds sitting in a Chase account or WisFis or wherever they bank.
Yeah, I think this
And
guy, he said he was getting like financing, but he didn't do a mortgage contingency. And he showed that he had the money in his bank account just in case the financing didn't come
well,
through.
that's okay if he did actually have the funds like cash, the liquid cash. But what happens almost every day in real estate, and other agents get mad at me when I tell you guys that you can't accept that offer. It can't be cash, no contingencies, but they're sending in a guarantee of funds letter from Tom, Dick, and Harry, hard money lending, and like nobody's doing that. You know what I mean? So
Yeah.
it is very important that on the listing side you're paying attention. And then also you will get green or even some seasoned investors who are used to having agents that don't know what the hell they're doing and have been putting in these cash offers for them. So their offers get accepted and everything's been everything. But then they're going to come across me and one of you guys. I'm going to be like, that's not a cash offer. That is financed. And they're like, oh,
Yeah,
but I'm
you
getting
definitely
money.
made me ask some additional questions for sure. Like
Yeah, I'm not
now I
because
remember.
yeah, because like this is what's crazy. Like our brokerage is under like, hold on, let me stop recording before I start talking shit. Hold on. So